Is the market overvalued? That is the topic today on The Informed Investor. Thanks to everybody for joining. I'm Mark Gochner, joined today by Jake DeKinder and Dr. Wes Krill. As I think about it, we've never established your PhD. What is your PhD in?
It's in material science and engineering.
You're just a lowly CFA.
I'm sorry. I'm trying to keep up. I was thinking about that. You and I started almost in the exact same month or so, didn't we?
I just hit my 15-year anniversary last week.
Yeah, mine will be in 3 weeks.
Yeah. Well, makes us veterans.
I don't know the point of that, but I was just
Mark's
thinking
got
about
a
that
few
this
years
morning.
on us.
Mark's got a few years
I got
on
a
us.
lot of years on you guys. Absolutely. And I'm the token CPA for the group.
You got your CFA too.
I do have CFA.
You're a smart cookie, man.
We got all the bases covered between the three of us.
That's right.
It's
We
great.
can't keep up with the West.
My role here, I'm the eye candy. I mean, let's be clear. All right, how about some headlines?
Let's do it.
All right, we love headlines. We're going to start with a couple here. The first one, lofty U.S. stock market valuations bank on earning strength. And then another one, 5 signs of a market bubble investors are tracking. Now, I do want to highlight before we get into that a little bit, we do have a special guest on the show today. Well, you're our special guest. We have a special guest. We got the Magic 8 Ball today.
Did you steal that off my desk?
I did steal it off your desk. And here's the question, Magic 8 Ball. Is the stock market overvalued? So let's just see here what it's saying. Whoa, it says yes.
Well, that's
It
all for
literally
today.
says yes.
Cut the program.
Okay, so that was the shortest episode we'll ever have. All right, let's talk about it. We got one opinion. Is the market overvalued? Magic 8 Ball said yes. Let's get your thoughts on this one. Around that. How do we think about the price of a security and what goes into that to determine if it's overvalued? Let's start with you, Jake.
Well, I mean, how do you think about the price of anything? I mean, let's say you want to go buy a restaurant, right? So how would you value a restaurant? How would you come up with a price for a restaurant? You'd say, well, there's all of the booths and chairs that are in there. If I own the building, that's great. The equipment that's in the back, maybe they've got a wine collection. I'm gonna value all the stuff that's there, right? And then you'd say, but also we're gonna generate cash flows going out into the future over the next 1, 3, 5, 10, really indefinite future. But to come up with a price today, you'd have to bring those future cash flows back to today's dollars, right? And that's discounting them back. But really, I mean, that's the price how you would come up with the price of a restaurant if you wanted to pay for it. And when people are thinking about companies, that's what they're doing. What's the company got? And what's the money they're going to make out in the future discounted back to today?
One thing I'm just going to highlight is you talk about the discount rate.
Mm-hmm.
So you buy all this stuff and you discount those flows at a certain rate. That rate is your return as an investor. So I just wanted to
you can think
connect
about those two together. You're right. Yeah.
So just when we're talking about a discount rate, that's the return
Expected
investor
return.
has. Expected return an investor has on that investment. All right.
Right.
Sorry, Wes.
No, I mean, you guys nicely summarized valuation theory, I think. The price is what you expect to receive in the future discounted back to the present. And that has ramifications, especially if you think about what a high versus a low price would imply. And I think this is where you get to, merging with some of the headlines about the what people are interpreting from today's prices. A price can be high for one of two reasons. It can be the expectations for the future, so the expected future cash flows are high, or it could be the case that those future cash flows are discounted at a lower rate. And the challenge, once we start talking about with stocks, is it's very difficult to disentangle which one of those is currently at play.
Explain why a discount rate would be higher or lower.
The discount rate reflects a number of things, right? So it could be the riskiness of the investment. So all else being equal, investors prefer lower risk. So a higher risk investment, they're going to demand a higher rate of return. It also can take into account other effects like taste and preferences. Valuation theory is totally consistent with that. So this is going to lead to investors demanding higher or lower rates of returns for different securities.
On the cash flow side, you're talking about built into those cash flow, the market's pricing in some sort of a estimated growth rate too on those. How do you know which is which? Can you come up with what an estimate is?
Well, you really can't with stocks. I think that's the challenge is, say valuations go up like they've been rising for the U.S. market in recent years. So that could mean one of two things. One, it could mean the expected returns are now lower than they were before if it was a discount rate effect. It also could mean expected future cash flows are now higher than they were before. Both of those are consistent with rising valuations. And if you can't tell me which one is which, then you really can't make a solid prediction about how expected returns have changed. And, we should draw a distinction between this and bonds, for example. So because you've taken the uncertainty off the table when it comes to expected future cash flows with bonds, when your coupon payments are scheduled, when the principal repayment is going to take place. So with bonds, when the discount rate goes up or when your yield goes up, prices go down. So you can see that connection more one-to-one, but with stocks, it's just not as clear-cut of an interpretation.
Is that a challenge with stocks in general, that they're just noisier?
It
when
is.
we say noisier, sorry, what do we mean by noisier?
So what it means is because stock returns are more volatile, then when you're trying to correlate anything with price movements, it becomes more of a challenge. You just can't see things as clearly in the data. That's just one of the challenges of doing empirical research on a volatile data set like stock returns.
But going back to that noise, what does that mean? It might mean, I mean, it could be anything that's impacting somehow those future cash flows. Is that essentially what we mean by noise? Or do you mean stock prices change so much, so quickly, that it's just hard to connect it to anything specific?
One analogy is, for example, if you're trying to time something that's in the oven, and say you're cooking a nice souffle for your family, needs to be in there for, I've never cooked a souffle. Say it has to be in there for precisely 30 minutes. Okay, well, one way that you can monitor the passage of time is a sundial. You know, when I was younger, my grandparents had a sundial out in the yard, and that is correlated roughly with the passage of time. The problem is the precision is not there, such that it's very difficult to time things to the minute with a sundial. So if you try and use the sundial as an oven timer, well, if you're off by 5 minutes, your souffle is going to be completely ruined. So that's why you want to use the digital timer on, you know, your oven, because that is a much higher signal to noise proposition.
It is interesting when people start to try to apply this precision in the markets to something that is really, I mean, your sundial example is a great one, right? But now let's think about what's the potential downside risk if you get it wrong. In one case, you ruin your souffle. In the other one, you could completely derail your retirement goals, depending on how you're trying to use these valuation ratios that we're talking about as a precise signal on what's going to happen in the markets.
Yeah, there's that effort to time the markets constantly. And you always got to evaluate the downside of doing
That's
that.
right.
But you talked about the valuation. So let's bring that up here.
Yeah.
And just think about where we are. You mentioned we've had a nice run here in the U.S. For many years. Particularly, we see that in, we'll call them the large growth stocks, which is made up of, you know, largely the Mag 7, those big tech companies who've driven a lot of that. So let's bring that up here and compare large growth as an asset class to, say, small value in the valuations. And I've got my little page here that shows the spread of the valuation.
Your favorite chart,
large
right?
growth. It's my favorite chart, for sure.
I mean, what jumps out from looking at charts of valuations for the U.S. market is they're very high, currently in the top decile of valuations historically. To your point, a lot of that is driven by large cap growth stocks. You know, that portion of the U.S. market is, you know, in that top decile in valuations. Small value, on the other hand, has been trundling along more along its historical norm. So, you know, again, you go back to what can I learn from this? The reason why people do pay a lot of attention to valuations is because the cyclically adjusted price earnings ratio, or the CAPE ratio, as people talk about it, has been shown to predict, directionally at least, future returns. So when they're high, which they are right now, that would imply that expected returns are lower going forward.
We're talking about money here. We're talking about wealth. We're talking about the stock market, right? And I think for the most part, everybody wants to figure out how they can accumulate more wealth. I mean, let's be realistic. We're humans, right? And everybody's looking for some type of an edge in the market, right? Whether we're talking about CAPE ratios, we're talking about PE ratios, a lot of the things that we've unpacked on this show, but you kind of have to push yourself and say, you know, there's really nothing that's been poured over more than stock market data. And if there was some reliable, like always reliable valuation metric or something that we could look at that gave you an edge, don't you think that everybody would know it and everybody would trade on it? And that's the hard part is you just don't have that many observations around these ratios and what future returns are to reliably structure an asset allocation around it.
That's a really good point. If it were this easy to figure out the direction of the stock market, then why do we see so few actively managed strategies are able to outperform index benchmarks?
Yeah.
It strains credulity that one number could have that much power. It kind of reminds me of that movie Interstellar, where Matthew McConaughey is being told by this principal that his son's test score is too low for him to stay in school. It's post-apocalyptic, only so many people can be in school, etc. And he looks at the principal and says, your waist is about 34, and what is your inseam, about 32? Principal says, yeah, why? What's the point? He said, so you're telling me you need two numbers to measure your own rear, but one number to tell me the future of my son? It's the same idea with the market.
Well, and I think we talked about this before, if you had that information, right, you wouldn't tell anybody about it. You just go out and trade on it. I mean, I'd love to have the secret sauce.
I went to Chat GPT, which I think a lot of investors are using more and more to think through, hey, give me an answer around markets. Is it overvalued, or what should I do with my investments? So here's the question I asked Chat GPT. The question was, if stock market has a high valuation, does it mean lower returns in the future? And the answer that he came back with said, oftentimes a high valuation equals lower future returns. And he gave a couple of ways to think about that. One is the CAPE ratio. You just mentioned that. So we talked about that. The other one is this concept of mean reversion. So I'm going to go back to my chart, and this is why I love it. And so what you're telling me is, I think what you're saying, when I look at a ratio like this, where large growth is bumping up on historical high spread between, on a PE ratio, large growth versus small value, and you look at the performance of some of these large growth stocks, let's say the last 10 years, it's so far ahead of what we've seen historically. Does that mean then reversion of the mean says, well, then it's got to just have lower returns to bring back to its long-term run average? And you're saying not necessarily from a statistical academic perspective?
Yeah, this is a testable hypothesis. We've run these experiments in the past when you just look at based on what the trailing premium has been between value and growth, or even the equity premium stocks versus bills. And then when that has been especially high in recent years, does that tell you anything about what the premium is going to be in the future? And by and large, the answer was no. We did not find sufficient data there. The valuation spreads themselves, I know that's another thing people look at. So we've been talking about at the market level, the CAPE ratios at the overall broad market level. But when you look at the differences in valuation ratios between, say, value and growth, does that have any information about the subsequent value premium? Again, you get into a little bit of a nuanced argument here, which is there is a correlation. So on average, the value premium has been larger subsequent to periods where those valuation spreads are wide. But again, you explain so little of the variation in the subsequent value premium that it just becomes not really useful in terms of a timing indicator. You mentioned opportunity costs earlier. When we were doing this research on trying to time these premiums to see if we could actually do it, a big part of the reason why these experiments were unsuccessful is because they missed out on when the premium was actually delivered. If that timing indicator was even slightly misaligned. And again, that's what's, I think, the inherent risk for looking towards these valuation ratios as a input into asset allocation decisions is you might miss out on the returns when they're actually presented.
We often talk too about, so what's the alternative? Let's say you are worried about the market dropping. Like, what are you going to do?
Right.
Just sit in cash
I know.
and risk those big years?
Yeah.
Is it an investor you have to get that long-term performance?
The growth versus value too is an interesting one in that we've seen is in the U.S. I'm going to focus on the U.S. and we can talk about outside the U.S. here, but you have seen these large growth stocks perform very well, especially relative to small value. And we were in Chicago last week and putting on the conference, and we got the question, which is, hey, has something changed? Is something different this time? Is it the right way to still look at this value versus growth relationship? And the gentleman brought up all of this stuff around AI. This is really different this time. He said, I know the late 1990s and the internet were a big deal, but this is completely different. And I mean, how many times have we gotten that question, right? And it was interesting to go in and kind of unpack it with them. If you go back and say, well, let's talk about the introduction of the railroads. Let's talk about the introduction of cars. Let's talk about the introduction of computers, of the internet. I think investors at all of these points in time are kind of making this argument of, well, it's different this time. There's a fundamentally different relationship between price and expected returns, how we think about growth versus value stocks. And I'd love to get your take on this, because the thing I tried to emphasize with him was you want to think about having logic on why you would expect to see differences in returns. And then you want to have a lot of data to back that up. And if we think kind of the logic piece of it, I mean, that to me is what we're talking about a little bit around this valuation ratio, which is all else equal, lower price, higher expected return, right? And that's kind of how we're thinking about the value versus growth relationship. And then you got 99 years of data in the US. And then the last point I'll make, and I'd love to get your take on all of this, is that this whole thing about value versus growth has really been centered here in the US. Because if you look outside the US, developed ex-US and emerging markets, you've actually seen quite a bit different story around this idea of the premiums last 10 years, correct?
Yeah, I mean, the value premium has been positive outside the US over the past decade, whether you're talking about developed ex-US stocks, emerging market stocks. And so, certainly some of those new normal scenarios probably would fall apart in the data. But you're right, there's a logic versus data element, especially when it comes to any of these valuation ratio indicators. If you're inferring that expected returns are going to be negative, that doesn't make any sense,
right?
Because for something risky like stocks, there shouldn't be a negative expected return. And so really, I think what people are talking about is maybe returns are going to be a little bit lower. Not necessarily negative, but maybe they're going to be lower. And even then, I think to your point, what are you going to do about that? Like, does that mean you're not going to invest in those? If the rate of return is going to be lower, but still positive, you're probably still going to want to have stocks in your portfolio. Where it might come into play actually is with your capital market assumptions. So if you're thinking about planning for retirement, you got to put in expected returns to figure out, okay, what is my future wealth going to be like that I can draw upon for income in retirement? And maybe you reflect a lower expectation for the equity return going forward in those assumptions where I say, okay, if returns end up being a little bit lower than their long run historical average, am I still going to be okay? But can they go negative? That seems very unlikely. On expectations.
That's a good point on how you can use it. I mean, you're sort of like developing a cone of outcomes that say, returns could be higher than expectations. They could be lower than expectations. And from a planning perspective, in all scenarios, do I think I can stay on track for my goals? That's actually a reasonably good way to use the valuations that we're talking about right here. But again, to try to time it, whether it's in the market or out of the market or this asset class or that asset class, man, it's just a tough thing to do.
Well, I think your proper plan incorporates both of those situations where you have a market where it's below historical averages. You probably got a time period where you did better than average. In fact, we've seen that in the data.
Yeah.
When you look at the returns of the market, what's an average year? Okay, an average year is way out here, usually really good, 20 plus, or pretty bad, but rarely does it just center on its long run average on a calendar year basis. Now, one other thing that you brought up, Jake, that I think we should talk about going back to outside the US. So let's go back to the valuation ratios of the U.S. compared to, say, developed markets and emerging markets.
Good point.
Is there anything there that can tell us about that where we see a pretty big spread between the U.S. and developed and emerging? How do we think about expected returns there?
Yeah, that's where there's good news for investors. If you were sensitive to this idea of high valuations for the stuff you have in your portfolio, the non-U.S. stock markets are substantially lower in terms of valuations, much closer to the historical norm, whether you're talking about developed ex-US or emerging markets. And so if you think about, okay, in a globally diversified portfolio, that's one way that you can mitigate exposure to the high valuation segments of the market. The other one, you were talking about value versus growth, is if you have an asset allocation that's overweighting small cap value stocks. By definition, those are going to have lower valuations. Like I mentioned earlier, they're closer to their long run historical averages. So again, that's another way that you can scale back your exposure to the highest valuation segments of the market.
We should also say too, we get a lot of questions of value versus growth. We get a lot of questions around Mag 7. And we're not here to say that the outsized returns that we've seen, well, first off, if you're in a diversified portfolio, you should be happy you captured those returns.
Great
right?
returns.
Pumping your
Love
fist,
it.
you captured it, right? It's that you just have to be careful extrapolating these outsized returns indefinitely into the future. And that's the point I always try to get across, right? Here at Dimension, like we're not saying we want to see Mag 7 stocks fall off a cliff or anything like that, because maybe we lean a little bit more towards small value. But the bottom line is that you do have a relation between when price does go up, that expected returns go down. And when we have looked historically and we've seen some of these stocks go on really good runs, they do really well relative to the rest of the market before they become the big stocks. But afterwards, they tend to have, as a group, market-like returns. So it's all about forming appropriate expectations going forward.
I think that's why this topic in our commentary is pretty interesting, because you talk about the Mag 7 and saying, hey, on expectation, I wouldn't expect those incredible returns to continue like we've seen them. They're probably maybe going forward, the data suggests it'd be more market-like once they become one of those top stocks. But we're also saying I wouldn't expect them to have really bad returns either.
No.
Because we just don't know.
We just don't know.
I mean, I guess you go back to the data, and I think you used the word reliably earlier, and you connect that to the research that's done. You just can't reliably say on expectation it's probably going to be anything different than a long run market return for that. A couple things jump out to me here. I think one important point is what you said is on expectation, having a negative expected return for stocks just doesn't seem rational, right? The stock market prices these to have a positive return in the forward. I think that's really key. I think the other part of this is know your horizon. The time frame around owning stocks is 2-3 years. That's the wrong way to think about it. This is 10, 20, 30, 40 years, right? So keep that in mind with stocks, and then have a plan. And your plan knows you're going to have some ups and downs through that. But what's your alternative? Even if it's below, let's say you don't get a historical 10% return, maybe it's 6 or 7. That's probably still going to help you keep on your plan for the long run there. So those are some of the things I think about here today. All right. Now, with that said, we haven't talked about the emotional part of, I guess, investing. And it is tough to see the value of your portfolio go down. And there's some strategies out there that could help minimize that. It's just in terms of what are they, and then what's the cost that comes into if you do want to minimize the downside of market performance. So let's talk about that in an upcoming episode and talk about ways you can sort of bring some stability to a portfolio in the most cost-effective manner. That work?
Sounds fun.
Like it.
All right. Thanks, everybody, joining us today. Hopefully that was helpful to think about market valuations. Don't forget to hit subscribe, and we'll see you on the next episode. Thank you.